Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone.
Good morning. Typically when we sit down to do these deep dives, we
Mm.
try to find a single narrative, a single thread to pull on,
A theme,
a
not
theme. But today feels less like a thread and more like a knot that someone has just set on fire.
A burning knot is a very, very polite way to put it. We're looking at Tuesday, January 20, 2026. And if you're just glancing at your terminal or, scrolling through your phone on the way to work, you might be feeling a significant amount of whiplash.
Massive whiplash.
Yeah.
Because we have two completely different realities just playing out side by side this morning.
Right. On one screen, you have the geopolitical dashboard just flashing absolute red. We're talking trade wars, diplomatic insults, and literally the Federal Reserve Chair sitting in the Supreme Court fighting for his job.
And then you flip to the other screen.
And you look at the market sentiment data, and investors are reportedly euphoric. It doesn't make any sense. It's a head-on collision. You have this high-stakes geopolitical theater crashing directly into a financial market that just seems determined to wear blinders.
So that's our mission for this deep dive. We've got the full stack of reports on the desk. We're pulling from CNBC, Bloomberg, Reuters, and the Financial Times.
All the big ones.
And we need to connect these dots. We need to explain how a dispute over buying an island, yes, a literal island, is threatening a global trade war, why the Fed is fighting for its life in court, and why, despite all of this, the smart money is supposedly all in on a bull market.
It is a lot to unpack, but we really have to start with the catalyst, the event that just dominated the overnight cycle from Asia to Europe.
We're talking about Greenland. And look, I know how this sounds to you listening. It sounds like a rerun from a few years ago. But according to the reporting from both CNBC and Bloomberg this morning, this isn't a joke. It's not a throwaway comment at a rally. This is deadly serious policy. It is. The reporting is very specific. President Trump has drawn a line in the sand. He hasn't just floated the idea. He has explicitly threatened to increase tariffs on 8 specific European nations if the U.S. is not allowed to purchase Greenland.
And we aren't talking about small adjustments here, are we? This isn't just a slap on the wrist?
No, not at all. The timeline is incredibly aggressive. The threat is for tariffs starting at 10% on February 1st.
February 1st, that's what, less than 2 weeks away?
Exactly. And then climbing to 25% by June.
Just to pause there. 25% tariffs on 8 European nations. That's a massive supply chain shock. That completely rewires how goods move across the Atlantic.
It's huge. And the diplomatic fallout was instantaneous. Did you see the note about Davos?
Yeah, the Danish government, they just flat out refused to attend the World Economic Forum this week.
Exactly. They're boycotting Davos in protest. But what's even more interesting, and honestly, what should be terrifying for anyone holding luxury goods stocks, is how personal this escalation has gotten. It's not just a blanket "Europe is unfair" argument. It's targeted.
You're talking about the French wine tariff.
I am.
This is where the story gets incredibly colorful. So Trump didn't just threaten general tariffs. He specifically singled out French wines and champagnes for a 200% tariff.
100%. That effectively prices French wine out of the U.S. market entirely. You're talking about wiping out the export market for Bordeaux and Champagne in America overnight.
But why France? What does a vineyard in Bordeaux have to do with the purchase of Greenland?
Well, Bloomberg had the scoop on this, and it's wild. This isn't about economics at all. It's about a text message.
I read this 3 times to make sure it was real. Apparently, this specific threat came after French President Emmanuel Macron refused to join Trump's new Board of Peace regarding Gaza.
Right, and Bloomberg actually published the details of the text exchange.
I have it right here. So Macron reportedly texted Trump, "I do not understand what you are doing on Greenland." That's it. That's the text.
And the response?
Trump told reporters that Macron is hostile and, quote, will be out of office very soon.
Which, technically is a reference to term limits. Macron leaves in 2027. But in this context, that is being read in diplomatic circles as a massive slap in the face. It's so dismissive.
It's extremely dismissive, but here's where we need to dig deeper for you, the listener. Because usually when the U.S. threatens tariffs, Europe tries to negotiate, they try to de-escalate. But the reporting from CNBC suggests the EU is taking a very different approach this time.
They are. They are not sitting on their hands. CNBC is reporting that the EU is preparing something they are calling a trade bazooka.
Trade bazooka, that is not a term you hear every day in Brussels.
No, but it fits. We're talking about the anti-coercion instrument, or ACI for short.
Okay, let's unpack this concept because we hear about tariffs all the time. We
Okay.
tax our steel, we tax our motorcycle. That's the standard playbook. What makes the ACI a bazooka?
So the anti-coercion instrument is a relatively new tool in the EU's legal arsenal. And it was designed specifically for this kind of situation, where a country tries to bully a member state into political compliance using economic threats.
Like threatening tariffs to buy someone's territory.
Exactly like that. And the scale is massive. Sources say the EU is ready to target 93 billion euros. That's about 108 billion US dollars of US goods.
Whoa.
But the ACI is different because it goes way beyond just taxing imports.
How so?
It allows the EU to cross-retaliate in other sectors. For example, it allows them to restrict access to public procurement markets in Europe.
Okay, let's define that. Public procurement, that means government contracts, right?
Correct. So imagine a U.S. construction firm wanting to bid on a bridge project in Germany, or a U.S. software company trying to sell cloud services to the French government. The ACI allows Europe to legally just say, no, you're banned because your country is coercing us.
That's a big deal for U.S. multinationals. I mean, that's locking them out of massive revenue streams.
And it gets worse. The Financial Times describes the nuclear option within the ACI, which is restricting intellectual property rights.
Restricting IP rights, that sounds incredibly dangerous.
It is the bedrock of the modern economy. If the EU triggers this provision, they could, in effect, suspend patent protection or enforcement for U.S. companies in Europe.
Whoa. So, theoretically, a U.S. pharmaceutical company or a tech giant could just lose their exclusivity.
In theory, yes. If they pull that lever, it means U.S. innovations just aren't protected in the European market. That's an escalation that goes so far beyond the price of champagne. That attacks the balance sheet of the biggest companies in the S&P 500.
That is huge. And you would think, hearing all of this, trade wars, 200% tariffs, IP rights being threatened, that the markets would be absolutely crashing.
Well, the immediate reaction this morning was negative. We can't ignore that.
Right. CNBC's market data is showing a slide. Asia-Pacific markets took a hit immediately. The Nikkei in Japan is down over 1%. And here in the U.S., the futures market is ugly. I'm seeing Dow futures pointing to a drop of anywhere between 300 and 600 points.
And the bond market is reacting too. Treasury yields are jumping. The 30-year yield is up 9 basis points.
Explain that relationship for us. Why do yields jump when trade war news hits?
Well, there are two reasons. First, tariffs are inflationary. If you tax imports, prices go up. So if investors expect inflation, they demand higher yields on bonds to compensate.
Makes sense.
Second, there's a risk premium. If the U.S. government is engaging in economic warfare, U.S. debt becomes, slightly riskier or at least more volatile.
Okay, so that's the rational reaction. Bad news equals red charts. But this is where we hit the paradox. This is the aha moment of the deep dive that has me just scratching my head.
The hyperbull paradox.
Exactly. I'm looking at this Reuters report about a Bank of America fund manager survey, and the numbers do not match the mood at all.
They really don't. While the headlines are just screaming doom, global fund managers are the most bullish they have been since July 2021.
How bullish is bullish?
Well, Bank of America has a bull and bear indicator. It ranges from 0 to 10. It just surged to 9.4.
9.4.
9.4. That is what they classify as hyper bull territory.
So they aren't just optimistic, they're absolutely euphoric.
And they are putting their money where their mouth is. The survey shows that cash holdings in these funds have sunk to a record low of 3.2%.
3.2% cash. Let's break that down. That means they have deployed almost every single dollar they have into the market. They have no dry powder left.
Precisely. When cash levels are that low, it means investors are all in. They are fully invested. They're betting everything in the market going up.
But what are they betting on? We just spent 10 minutes talking about a trade war that could dismantle the global order. What are these fund managers seeing that we aren't?
The survey says they are betting on an economic no-landing scenario.
Okay, we hear soft landing and hard landing all the time. Can you clearly define no landing for us?
Sure. A hard landing is a recession. The Fed raises rates, the economy breaks, we crash. A soft landing is the Goldilocks outcome. Inflation comes down, growth slows gently, but doesn't break. A no landing, that's different. It means the economy just keeps growing. It doesn't land at all.
So it just powers through.
It powers through. Growth stays high, corporate earnings are strong, and the economy essentially ignores the high interest rates. They're betting that the economy is just bulletproof.
That it can shrug off all this geopolitical noise like it's nothing.
Yes, but here's the danger. That 3.2% cash level, that is a classic contrarian signal. If everyone is already all in, who is left to buy? If a shock hits, like, say, a trade war over Greenland, there's no cash on the sidelines to cushion the fall.
It feels like a massive game of chicken.
Hmm.
You have markets priced for perfection, priced for maximum growth, while the political reality is just shifting toward barriers and conflict.
One of those narratives has to break. You cannot have frictionless global growth in a world of 200% tariffs. It's just not possible.
Speaking of friction, let's pivot to where the global elite are currently gathering to try and make sense of this mess. The World Economic Forum in Davos.
The snow is falling in Switzerland, but the mood is, let's say, it's tense.
CNBC has the attendance list, and it's a fascinating read. Trump is attending in person, which is a big deal in itself.
It is. It's his first time back since 2020. And reports say he's bringing his largest delegation yet. He isn't just going to shake hands. He is going to make a statement.
And looking at who else is there, Jamie Dimon from JP Morgan, Volodymyr Zelensky, Jensen Huang from NVIDIA, it's the heavy hitters. But the snubs are just as telling as the attendees.
Right. No Xi Jinping from China. As we mentioned, no Danish representatives because of the Greenland dispute. And Downing Street was very cagey about whether UK PM Keir Starmer would show up, though he's expected to be there.
It feels fragmented.
It is fragmented. Davos used to be about globalism, everyone holding hands and singing Kumbaya. Now it looks more like factions facing off against each other.
And the real buzz in the Davos hallways, according to Bloomberg, is about this board of peace Trump is trying to form. We mentioned it briefly with the Macron text, but the details are, they're actually mind-blowing.
It's being framed as a vehicle to reconstruct Gaza, but the scope seems to be expanding to global conflict resolution in general. But what's really raising eyebrows is the buy-in structure.
That's the part that got me. Bloomberg reports that countries wanting a permanent seat on this board are being asked to contribute at least $1 billion.
$1 billion entry fee.
And Trump would serve as the inaugural chairman.
And he's invited Putin, China, to join.
Which explains why Macron and others are so hesitant.
Hesitant is putting it mildly. The critics are fearing this undermines the United Nations entirely. It creates this parallel structure for a global diplomacy.
Pay-to-play diplomacy.
Essentially, yes, run by the U.S. president. It disrupts the entire post-WWII order, where every nation had a voice, regardless of whether they could cut a $1 billion check.
It's definitely disrupting the vibe at Davos. But while the president is in Switzerland, there is a massive domestic battle happening right here in Washington. And honestly, for the long-term economy, this might be even more consequential than Greenland.
I agree. This is the story that could change the structural integrity of the entire U.S. financial system.
We're talking about the Federal Reserve. CNBC is reporting that Fed Chair Jerome Powell is doing something incredibly rare. He is personally attending oral arguments at the Supreme Court this Wednesday.
It's highly unusual. I mean, for a Fed chair to be in the courtroom like that, usually this in the general counsel,
Hmm.
for Powell to be there physically signals that he views this as a genuine existential threat.
And the case is technically challenging Trump's attempt to fire Fed Governor Lisa Cook. Trump claims she committed mortgage fraud, which she denies. But this isn't just about Lisa Cook, is it?
No, not at all. Lisa Cook is the proxy. The real legal question here is, can the president fire a Federal Reserve governor for cause? Or are they protected? If the court rules that the president can fire them easily, then the independence of the Fed is effectively gone.
He could just fire anyone who disagrees with his interest rate policy.
Exactly. And it gets messier, because while this is happening, CNBC reports that Powell himself is now under criminal investigation.
Right, regarding the renovation of the Fed's headquarters.
The timing of which is interesting.
Powell certainly implies so. He released a statement, which CNBC quoted, claiming that this investigation is a pretext. He says the real reason is that the Fed refused to lower interest rates as quickly as the president wanted last year.
So let's just pause and look at this picture. We have the president threatening trade wars over Greenland. We have the markets at record bullishness. And simultaneously, we have the White House and the central bank in an open legal and criminal brawl at the Supreme Court.
It's an institutional crisis.
It is. The market loves that no landing scenario we talked about. But that scenario relies on a competent, independent central bank managing inflation. If the president can fire governors or threaten the chair with criminal probes because he wants lower rates,
then the market can't trust the Fed to fight inflation anymore.
exactly. If the market loses faith in the Fed's independence, inflation expectations become unanchored, and that hyper-bull case falls apart fast.
It's a very precarious deck of cards. Okay, with all that swirling around, let's hit a lightning round on the asset classes. How is money actually moving right now in response to all this? Because usually when the world gets scary, people run to safety.
It is a flight to safety, but with a twist.
Let's start with the classics, gold and silver.
Hitting new highs, according to CNBC. That's your classic fear trade. When trade wars loom, when currencies get weaponized, people buy shiny metal. That correlation is holding up perfectly.
Okay, but what about digital gold? Bitcoin. For years, the narrative has been that crypto is the hedge against all this chaos.
And this is where the narrative is taking a big hit. CoinDesk is reporting that Bitcoin is down.
Interesting. So much for being the safe haven.
Yeah, the report explicitly mentions that as geopolitical risks are rising, Bitcoin is reacting more like a risk asset, like a tech stock, rather than a safe haven like gold. When fear goes up, Bitcoin is getting sold off.
That's a crucial distinction for investors.
It is. And the survey data CoinDesk cited is really telling. Geopolitics has officially overtaken the AI bubble as the top tail risk for investors.
That makes sense. You can't code your way out of a tariff war. Finally, just a quick note on Asia-Japan specifically.
Yes, just to add another layer of uncertainty to everything, CNBC notes that Japan's Prime Minister Sanai Takaichi has called a snap election for February 8th.
February 8th has barely 3 weeks away.
Right, and that political uncertainty in Japan is contributing to the slide in Asian markets we saw today. It's just one more variable in a very, very complex equation.
So what does this all mean? Let's try to synthesize this for the listener who is maybe driving to work, hearing about Greenland and bazookas and billion-dollar peace boards, and wondering if they should check their 401k.
I think the picture is one of extreme divergence. You have a hyper bull market that is priced for a perfect economic outcome. Investors have dumped their cash and gone all in on growth. They're betting on this no landing scenario where the economy just keeps chugging along.
But the world stage is hyper tense.
Exactly. You have politicians erecting barriers, threatening 200% tariffs, and fighting over the independence of central banks.
It feels like the markets are playing a completely different game than the governments are.
They are. The markets are looking at earnings sheets, and governments are looking at maps of the Arctic.
And usually politics eventually impacts the earnings sheets.
Eventually, yes. The gravity of the real world usually pulls the market back down to earth.
Before we go, we always like to leave you with something to chew on, a provocative thought to carry you through the day. What are you thinking?
I'm thinking about that trade bazooka. The market is assuming this is all just bluster, threats of tariffs that will eventually be negotiated down. That's the standard assumption.
Yeah.
But ask yourself this. If the EU actually pulls the trigger on the anti-coercion instrument and restricts U.S. intellectual property rights in Europe, if a U.S. tech giant suddenly can't enforce its patents in France or Germany, does that no-landing economic scenario instantly turn into a crash?
Yeah.
Because that is a risk, the devaluation of American IP that I don't think is priced into a market with 3.2% cash levels.
That is a scary thought. Intellectual property is the bedrock of the modern economy. If that becomes a casualty of a trade war over Greenland, well, we are in uncharted waters.
Indeed we are.
On that cheerful note, we're going to wrap it up there. We'll see you all tomorrow morning with new headlines from major financial magazines.